quarter numbers. Now, moving on, Yes Bank has also reported its fourth quarter numbers, and they also beat estimates. Net profit rose by 63% over the previous year, but loan growth was the slowest that we've seen in at least the last 7 quarters. Abhishek Kothari is back with us to decode the earning fine print.
Well, control over cost of funds has actually helped the net interest margin and the P&L of Yes Bank in this quarter. So take a look at the P&L versus our poll. The NII is a beat of 4.3%, while the PAT beat is about 23.5%. Net interest margin is at 8-quarter high of 2.5%. The loan growth is very weak, one of the weakest that you are seeing in last 7 quarters, just 8.1% YOY and about 0.55% sequentially. The securities receipts are now nil, so basically they are now zero. Other income has also aided the top line growth for them. So other income is up 15% quarter on quarter, as fee income is up 21.5% on a sequential basis. So overall the loan growth was weak, but they made up in the fees. Fee income was very strong for them. So cost to income ratio hence is at the lowest in last 15 quarters, coming in at 67.3% versus 71.1% in the previous quarter, as OPEX has declined by more than 4% YOY. Annualized slippage ratio is at 10-quarter low, coming in at less than 2%, 1.99% versus 2.2% in the previous quarter. Net NPA ratio is one of the lowest that you are seeing in last 8 years or even more. Net NPA ratio is now down to 0.3% versus 0.5% in the previous quarter. Quarterly annualized credit cost is at 4-quarter high of 1.48% versus 1.26% in the previous quarter. Looks like there might have been a bit of write-off which got provisioning this time around. Return ratios, they are one of the best for the bank in last 25 quarters, but one of the weakest when you see with respect to peers performing, because return ratios continues to remain tepid when compared to peers, but one of the best in 25 quarters. ROA at 0.7% versus 0.6% in the previous quarter. ROE at 6.2% when compared to 5.2% in the previous quarter. Back to you.
All right. Thanks very much, Abhishek, for helping us